The part that a lot of people don't get about the royalty and streaming space is that the best years for product acquisition are not behind them. They're ahead of them. That happens because the world needs about $200 billion to build out big copper projects. And the world is about 150 billion short of the 200 billion that they need. Selling the byproduct streams around those big porphyries, selling the gold and copper by way of a stream or a royalty, provides a disproportionate share of the development capital to build those big copper projects. My suspicion is that you will see 30 or 40 billion dollars in royalty and stream transactions in the next 10 years around building out the copper porphyries, which means that there's room for everybody.
When you're looking at Franco and Wheaton, and I wanted to ask you about this, was one of the biggest risks I see in the royalty space isn't necessarily the royalty model I absolutely love, and I couldn't see why you wouldn't, is the new entrance of Tether. I feel as though Tether have got a better cost of capital than most of the existing ones. So Franco and Wheaton, they've bought 30% of Elemental Altus, or now Elemental Royalties. They've bought, I think, about 10% of gold royalty. I think maybe they might be up to 7% of Metalla. I'm now hearing that they're actually going and buying up mines themselves. It seems like Tether want to get into the gold space, and I think if they want to consolidate the royalty space, that's a big competitor, and potentially for future. For me, I'm just thinking further ahead. If they really wanted to get involved in this space, they could be a pretty decent competitor in terms of new business for the royalty companies.
Understand that when Tether buys gold, it buys it for token holders.
Yep.
When they buy gold stocks, they're buying it for their own account. They're not buying that on a coin. Their cost of capital is real. The second thing is that Wheaton and Franco in particular, but the mid-tier royalty companies too, have a current structural advantage given that they have the exploration upside from their existing portfolio, which is much more paid for.
And the expertise as well, right?
But the third thing, well, the Tether guys are very smart, and they have access to a reasonable amount of expertise from the juniors they've already bought.
Oh.
I know those people. I was a founding shareholder of Altus. I was a founding shareholder of EMX.
Yeah.
I know those people well for 25 years. Those are high quality people. They chose wisely. But the part that a lot of people don't get about the royalty and streaming space is that the best years for product acquisition are not behind them. They're ahead of them. That happens because the world needs about $200 billion to build out big copper projects. And the world is about 150 billion short of the 200 billion that they need. Selling the byproduct streams around those big porphyries, selling the gold and copper by way of a stream or a royalty, provides a disproportionate share of the development capital to build those big copper projects. My suspicion is that you will see 30 or 40 billion dollars in royalty and stream transactions in the next 10 years around building out the copper porphyries, which means that there's room for everybody.
Okay, so there's no risk of Tether sort of coming in and...
If Tether's cost of capital at the parent level gets low enough, what they should do is do something like buy Sprott or buy Cisco. Why would you recreate the wheel?
Funny how they've come into that sector. I do wonder how that's going to change things. I even wonder if, I don't know, is a Wheaton and a Franco too big for Tether to acquire, do you think?
Well, at present, Tether isn't just the biggest buyer of gold in the world. They're the biggest buyer of U.S. treasuries in the world. Basically, any asset class that has a bid can be securitized in the crypto market. Tether has gone from nowhere to being one of the 4 biggest asset managers in the world. Right now, their fee stream going upstream is attractive, but it's about to be huge. And there may come a time 3 or 4 years from now, when the free cash flow that goes upstream allows them to do whatever they want. Will an industry as small as gold be attractive to a player that's the largest buyer of U.S. treasuries in the world? I don't know the answer to that. Well, I mean, it stands to reason that they could pay to issue a coin that was the S&P 500. Would that be a bigger and more attractive market for them than gold? I don't know. I'm asking rhetorically. One wonders, given the size of the opportunity in front of Tether and their current market share in distributed ledger domains, whether gold is an asset class that has sufficient size to harbor their ambition.
But it is, I do find it funny that with Tether, for example, we were talking earlier about how underallocated everyone is in the Western world in terms of the asset managers and the institutions. Tether seem to get it. They seem like they're huge gold balls and want as much exposure to it as possible.
I've had the good fortune to talk to some of the senior managers of Tether individually. They're gold bugs.
They are.
They're gold bugs.
I thought they might be, given what they're up to.
Yeah.
Okay.
Yeah. No. I mean, they may not have drank as much of the Kool-Aid as I have because I'm older.
Yes.
But they certainly get the narrative. And when I was visiting with them and went into what I call the arithmetic of America, clearly they were already versed in that.
Yeah. Well, yeah. You'd think they would be, given what they're doing with the treasuries and whatnot. I guess just to close things off, obviously, we've spoken about what you're doing on the oil and gas side. We spoke about that you're doing Franco, Wheaton, Agnico, buying physical gold. We've spoken about the silver side of things. Is there anything that we're missing in terms of the sort of hated parts of the industry that people perhaps should be thinking about that aren't spoken about so much at the moment?
I guess there's three sort of general things. The first is that when you are looking forward in terms of escalation in commodity prices, you need to look forward, if that's the right phrase, to escalation in mine development costs, social rents, and operating costs. What that means is that existing producing assets are worth more than the market thinks they are. What is today a $5 billion copper porphyry development will next year be a 6, and afterwards will be a 7.2, and afterwards will be a 10. Somebody who has already spent the 5 and is in production with 30 years of reserves is worth more than people know. They're also valued on a net present value basis, a discounted cash flow basis, which means for a company with 30 years of production, the last 20 don't figure into today's price. But that 20 years of reserves will come in awful handy 10 years from now. So I would ask people to take a look at their portfolio and incorporate more large cap, high quality companies, because the current market conditions understate the advantage that incumbent producers have. I would also urge your audience, and I'm doing this not with a knowledge of your audience, but a knowledge that comes from grading almost 100,000 portfolios over 35 years. What I've learned is that many investors get the big picture right, they get the strategy right, but they get the timing wrong. They have a 5-year strategy and they have 3-month tactics. And if your tactics are different than your strategy, you're going to lose money. In this business, you have to be very patient and you have to be very tenacious. You will have, at some point in time in this gold bull market, you will have a 20 or 25% or even 50% decline in the gold price. You will have that. Every gold bull market that I have ever participated in my life had more than one 25% decline. If you aren't psychologically and financially prepared to weather that, you can be right about gold in 10 years and still lose all your money in 3.
Yeah, so true. Yeah, no, I agree. Just one last question. On the sort of gold producing side, you mentioned one name, which was Agnico. Are there any other producers that you would look at and think, you know what, there's still a lot of value there on the gold?
For a risk-tolerant investor, I could pound the drum on B2.
B2, yeah.
Pound the drum.
Yeah.
The stock price has fallen by 2/3 as a consequence of Mali, which is a problem they solved, and as a consequence of Goose in Nunavut.
Yeah, but that's in production now, or going in.
That's the point.
Yeah.
You'll remember a couple of years ago, Equinox fell by half when they were late and over budget delivering Green Zone.
Yeah.
And when they finally got that mine turned on. When it finally started to work, bang, the stock doubled.
And that helped them get the Valentine mine, and then off they went, right? And look at them now.
It may well be 6 months before B2 shakes out.
Yeah.
But when they shake out, I suspect you're going to get the same share price performance out of BEMA that you got out of Equinox. I'm not going to wait 6 months. I'm already a B2 shareholder.
Yeah, so am I. Yeah.
But as we speak, I'm bid.
And then just any updates on the uranium space? Any changes in view on that?
I think the uranium juniors are fully priced.
They're fully priced.
Yeah. Having said that, looking out in 5 years, the uranium market is structurally the strongest of any resource market I know, because the juniors have the ability in uranium, unlike any other market, to lock in prices and volumes for 20 or 30 years with investment grade counterparties. Every other commodity that I know, with the exception of direct electricity, you're a slave to the Sprott market.
Yeah.
If you and I buy a gold stock, we can have an opinion as to where the gold price is going to be, but we're tied to the spot market for the rest of our lives.
Yeah.
If, by contrast, we're in the uranium business, we can sign a contract with Tokyo Electric Power or Duke Power or Southern Company.
Just waiting on these contracts to come through, though, right? You know, the big ones that we're waiting on, Cameco and the rest of them. It did feel like when we were at the WNS a few months ago, it still felt like there was that battle going on between the utilities and the mining companies. Are you hearing anything where that could be getting resolved soon?
Oh, it'll be resolved over time.
Yeah.
I mean, for one thing, about once a quarter, people get interested in uranium.
Yeah.
$50 or $100 million flows into the Sprott Physical Uranium Trust, and they go out and buy 2 million pounds. That bag of uranium is now 80 million pounds, and it's gone to supply heaven.
Yep.
The biggest single piece of uranium supply on the planet is off limits to producers, and it gets worse every year. It gets worse every quarter for the consumer.
Yeah, well, it's interesting how much the Sprott ETF is now having an impact on that spot market as well, right? So I do wonder, we had a chat with John who runs the ETF at the show. It seems like he's more than happy to keep raising more and more money if it's at a premium and keep buying more and more uranium. So
why would he not?
See what happens next year, but if they can continue to put in some pressure on the price, and then we do finally start seeing these resolutions in the market, in the long-term markets, it does seem like we're getting ready for a big year, maybe next year, maybe the year after, but maybe next year in uranium. It seems
to me like it's a matter of time.
Yeah.
I look at Kazatomprom's inability to increase production as an example.
Yeah.
And I listen to the quarterly conference calls around Cameco and what they believe to be the incentive price. There are some smaller projects which have been announced, but they don't matter. I mean, they don't matter. People are really excited about 2 million pounds, and for them, that's great, right? It's $160 million. But to the uranium business, I mean, Sprott sweats more uranium.